Welcome everyone to tonight's webinar. Tonight's webinar is part one of a two-part series. My colleague Joe Feng and I are going to be hosting. We're very excited about this. We put a lot of work into it. We've been talking about it for some time. Debunking Multifamily Myths, part one. Before we start, I just do want to let people know we're going to wait to the very end to accept questions. However, at any point you have a question, please go ahead and type it in the Q&A box, not the chat box, the Q&A box, and we will answer all your questions at the end of tonight's webinar. So just have to show this on the screen. Do not worry, not going to read the whole part to you. We're not giving advice tonight. This is just for confidentiality and disclaimer. The same here with the financial disclaimer, just going to show it on the screen. Not gonna read it to you. So Break a Day Capital, I know many of you are familiar with us, but our CEO and founder is Gary Lipsky. He's been a real estate investor since 2002. So he's been doing this for well over 2 decades. He's a serial entrepreneur. He co-founded a company that grew to over 700 employees that helped over 9,000 students. He has written a best-selling book called Best in Class, which I highly recommend. If you've not read it, check it out. On our webpage, you can order it. Just have to pay for shipping. He's also the board member of a nonprofit, Core Educational Services. Now, our bios, Joe's and mine. First thing on the left part of the screen, Joe Feng. If you'd like to connect with him, just go right to that QR code with your phone, and you can connect with him. We're going to give our contact information at the end of this presentation as well. But Joe, he has been, actively involved in residential investing for quite a time, and you're reading that correctly. He has invested in over 50 commercial real estate syndications across various commercial real estate sectors. He has invested in 6 Break of Day capital deals before he officially joined the team in 2022. And prior to focusing on real estate, Joe worked in the investment management business, which included 5 years at a hedge fund in New York and 7 years with a large institutional fund manager in Los Angeles. Joe loves what he does. He loves conversing with all types of investors and really enjoys talking about macroeconomics, real estate, alternative investments, and health as well. Like Joe, my background is Wall Street. I spent over 20 years on Wall Street. Unlike Joe, though, I was the other side of the phone. I was doing the covering. I was covered some of the best performing hedge funds, mutual funds, and family offices. Would have loved to have covered Joe. Unfortunately, our paths did not cross until real estate. And just prior to joining a Break of Day Capital, I was a multifamily realtor in Arizona. I facilitated deals throughout the state. And like Joe, I love what I do. I love building connections, talking to investors, and helping them achieve their financial objectives through real estate investing. Like Joe, if you'd like to connect with me on LinkedIn, just put your phone up to that QR code and we connect. Although there's not a lot of Adam Dreschers out there, so if you just type my name in, you should be able to find me, no problem. So Break a Day Capital, what do we do? What we do is we focus on underperforming multifamily properties, specifically in the Southwest. Once we acquire the property, we implement strong repositioning strategies, best-in-class asset management to maximize value for our shareholders. And it's always a win-win too. Our tenants actually love what we do too. Our tenants actually stay at our properties much longer than the national average. We are recognized by the AAOA, the American Apartment Owners Association, which is a 140,000 member strong organization, in 2023 as the best syndicate company of 2022. Inc. magazine recognized us as the 25th fastest growing real estate company in 2023. And we've acquired over 1,600 units with a total value of 280 million in real estate. As I mentioned, Gary's written a book, which I highly recommend you check out, but he also does a weekly podcast. Joe and I have both been guests on his podcast before. If you have an iPhone, just under that podcast app, you type in Gary Lipsky or Break of Day Capital, you can subscribe to it. But one thing here too, just about Gary's book and what he does is, really stresses the part of the asset management. A lot of operators and syndicators, they focus on the acquisitions and the capital raise, but they really overlook asset management, which is a key part of the investment process. So that's something that we really focus on. And the results have been phenomenal. Our the last 9 deals, we had a 40% boost to the bottom line, the net operating income within the first 12 months. And our last deal as well, we have a game plan in place, and it's already tracking to be on that way as well. So here's our, I'm a big believer that you're the average of the 5 people you spend the most amount of time with. And this is just a snapshot of our team. We have a phenomenal team. I'm not going to go through everybody's bio, but we are in contact throughout the day. We talk a lot, share ideas. So we just have a phenomenal team here at Break of Day Capital. Now, our mission. This is something that people often overlook when they're doing their due diligence on the syndicator and their team, which I think you should pay very close attention to. So our mission is to provide investors with superior risk-adjusted returns with the highest level of transparency, fiduciary responsibility, while improving the quality of life and communities of our residents. As I mentioned, our deals have been a win for both parties. It has been a win for our investors and our residents. Our residents, on average, stayed at our properties 34.8 months, which is much longer than the national average of 27.5 months. Our core values: integrity, transparency, communication, diligence, and Kaizen. Kaizen is a term not everybody's fully familiar with, but what that is, it's a Japanese business term that talks about continual improvement, to always look to better yourself and better your team. And that's something that we really uphold to and really look to do. A lot of just slight adjustments can make, can really benefit your team and your product. So with that, my colleague Joe Fang is going to take over. He's going to do myths 1 through 3, and I'm going to do 4 and 5. As I mentioned before, anytime you have a question, please go right ahead and type it in the Q&A box. And I know a lot of people too I talk to often say to me, I got a silly question, stupid question. No, you have a question, and we were here to answer them. So please don't ever think your question is silly. We're here to answer any question. I guarantee what you deem a silly question, we've been asked numerous times before. Tonight too, we're gonna have some fun, and we have a couple polls we are going to ask you. When this flashes up on the screen, please click your answer to this. The first question we have for our audience tonight is, on what hit fictional TV show was Gary Lipsky mentioned on? Your choices are Suits, Law and Order SVU, Blue Bloods, or Melrose Place. So please click your answer. Don't be shy. This is just going to be up on the screen for a little bit. I have to end this in a few seconds before Joe takes over. But we will put your answer in there. Click your question at the very end. During the Q&A section, we're going to we'll reveal the answer. Gotta end it, guys.
All right, Adam. Thank you so much for that. A lovely introduction. So it's been said that if you keep repeating something long enough, people will start believing it, but that doesn't make it true. So tonight we're gonna talk about debunking some of these things that you might hear on social media that may or may not be true. And so, like with everything, the devil's in the details. So let's go ahead and get into this. So myth number one, always use long-term fixed rate debt. This is something that I've been seeing on social media for the last 2, 3 years. And I get it, I get it. Nobody expected interest rates to rise so rapidly in such a short amount of time. It's really unprecedented and it caught a lot of people off guard. And so it's natural, to sort of react to and say, oh yeah, if you just always use long-term fixed rate debt, you would be immune to this. Well, it's not that simple, right? I'm here to tell you, having invested in over 20 years, that there is no such thing as one perfect tool for anything, right? You have to have the right tool for the job. And so rather than saying, oh, one type of debt is better than the other one, um, really, you really just want to make sure that the type of loan that you put on, whether it's bridge, short-term bridge, fixed floating, long-term fixed floating with a rate cap, you just got to make sure that it's appropriate for the business plan. So like, for example, if you're going to do a value add where you expect to increase NOI significantly over the next, couple of years, which is something that we're really good at, it just doesn't really make sense to put on, long-term, really long-term, 5, 7, 10 year fixed rate debt, um, knowing that you would increase the value so much that you'll either be able to sell the property and make a above average, above projection returns, or you are in a position to refinance out the equity and then just hang on to the property for the cash flow. What happens is, when you put on uh, really long-term fixed rate debt for this particular business plan, is that it limits your option to either refinance or exit. Because what a lot of people don't tell you is that most long-term fixed rate debt, particularly the agency type, the Fannie and the Freddie ones, they come with very steep prepayment penalties. Now, a lot of homeowners are used to 30-year fixed rate debt with no prepayment penalties, and unfortunately, we don't really have those in commercial real estate. As far as I remember, I think the longest rate debt that we could get, longest maturity we can get is 12 years. But the prepayment penalties are really, really steep. And generally speaking, you can expect to have to pay whatever the interest payment would have been accrued through the entire whole period, when you go to exit, and that could be in multiple millions. In fact, I remember when I started investing in syndications, 7 years ago, um, everyone was talking about, yeah, let's do fixed rate debt, and then when they try to go exit in 2018, 2019, they were hit with a couple $1 million of prepayment penalties, and then decided to, and then Mantra had switched penalties not as steep or as onerous. Okay, on the other side, if your business plan is to is to acquire a stabilized asset where you're just going to hold long term for the cash flows, you're not really going to do much to the property, then it makes sense to put on long term fixed rate debt, uh, because if you're not planning, if exiting, in 3 to 5 years, or even shorter, is not in your business plan, then it doesn't make sense to put on, short-term debt where you may be subject to interest rate fluctuations. Um, there's even you know there are some operators that I admire and respect, that actually like using long-term floating rate debt with the interest rate cap. And what that is basically instead of fixing the loan, it allows the rate to float, but you put on an insurance. It's basically a swap where you're buying a cap that the interest rate can't go above a certain amount. If it does, the insurance company will pay for whatever the additional interest payments that would be due, due to market conditions. Um, so that this could be a potential hybrid, strategy where you can put on long-term rate debt with less prepayment penalty or no prepayment penalty, but you just have to hedge it with the interest rate cap. Now, just to kind of let people know what's going on in the last couple of years is that this strategy, again, is also not foolproof, right? When interest rates go up so much in such a short amount of time, when people put on this type of debt, whether it's a 7-year debt or a 10-year debt, they're usually buying 3 years worth of insurance at a time. Normally, this insurance is pretty cheap because interest rates usually don't fluctuate this much. But what's happened in the last 2-3 years is that because there's so much uncertainty where the rates are going, the cost of this insurance has just skyrocketed. I mean, we're not talking about $50,000 dollars for 3 years to 60,000. It's like 50,000 to like over $1 million, and this is a part of the reason why some operators are having issues because they're having to reserve money or cash to pay for more insurance on these interest rate caps. So again, just to reiterate, it's not that, I think the biggest takeaway for myth number one is it's not so much one type of debt is better than another type. It really comes down to the experience, the track record, the operational expertise of the operator. Because really, we talk about this all the time, Adam. It's like, when you're investing in real estate, you basically have to marry the operator. We're gonna do a deal together. We're gonna be with each other for 3 to 5 years, and you have to, know, like, and trust, the team, right? And until you get to know us really, really well, you're gonna have to depend on our expertise, right? And that comes through with our track record, our skin in the game. Basically, when we do these deals, we have a lot of skin in the game. I mean, we're signing on the loans, we're putting in millions of our own dollars. We make sure that we have way more to lose than anybody who's investing with us, so that there's always a constant reminder that we can't screw stuff up. And just as an additional note, and this is something that most operators will not have the expertise in, but luckily, I can say that we do, which is that, we have somebody on the team that, spends 10, 12 hours a day just looking at macro data, just looking at interest rates, the amount of money printing, where the dollar is moving, and how that all ultimately ends up impacting multifamily asset values and our cost of capital. So when we take a lot of this research, a lot of understanding of cycles, and basically incorporate that in our business model, so we kind of know when to take the foot off the gas and when to go for it. And so I feel like this is, in addition to asset management, this is one of our secret sauces. All right, myth number two: not underwriting properly to account for the recent rate hikes. Um, yeah, this one, if we, Adam, if you can go over to the next slide. Yeah, this one's pretty simple, guys. If you ever looked at any operator's underwriting model, try sticking in an assumption of a 5%, 6% rate increases rate increase, your modeling would just blow up. Like you would not buy a deal. I mean, you would have to offer, I don't know, 50% less than what the market dictates. And so it sounds nice, but in reality, that's not how it works. The seller's going to want fair value for their asset. And just because you think that the rate, just even if you have the foresight that rates were going to go up, 5.5% in 12 months or 16 months or whatever it was, you could present that model to the seller and they'll just laugh you out of the room. Yeah. So again, myth versus reality, right? Yes, it would be nice if we could, get a 30% discount, 40% discount on a property, 2 years ago. Um, that's not realistic. But what we can do is we worry about the things that we can control. Okay. So what does that mean? Well, uh, having invested in real estate for over 20 years, there's some truth that I've discovered and experienced, which is real estate investing will tend to work out fine as long as you have liquidity and time. If you run out of either one of those, you're screwed. Okay. And so we make sure that we are never, to the best of our ability. I mean, we're not magicians, right? We still have to work with the market or what the market gives us. So um, we do our best to make sure that those two things don't become an issue for us. And so the best way to mitigate risk really is just to have as much liquidity as you can, right? What does that mean? Well, when we do a deal, we make sure that we set aside money for all the big components, like the roof, like the HVAC, like the plumbing, and even if they're not needed, right? Even during our due diligence, even if they're in good shape, we still go ahead and set aside capital for that, save it for a rainy day, right? And then we'll also make sure we keep, several months of operating reserves, as if, the property's not cash flowing and we can handle a fair amount of stress. And then behind that, we also keep a lot of liquidity at the corporate level. At the end of the day, an experienced operator we always try to make sure we have options. And when you have cash, when you have liquidity, you have a lot more options. All right. Myth number 3. The real estate market is crashing. Oh my God. This this irritates me more than anything. And this is, this is coming from somebody who's been through a couple cycles, right? Like there's all these like, YouTubers, I forgot what the one is, and they always get quoted for like doomsday stuff. It's like, guys, really, this is clickbait, bad news, sells. Okay. It's great for advertising, but the reality is the real estate market is not one market like the stock market. Okay. It's very fragmented. In fact, if you listen to some of Robert Kiyosaki's like old interviews, he'll tell you that even in 2008, during the great financial crisis, while almost everything's crashing, the coastal states, Arizona, even, Florida, California, New York, whatever. But Texas was doing fine, right? That, at the time, there wasn't a ton of in-migration to Texas yet. And the real estate prices were still very reasonable. And so they hardly saw any, major declines. And so the point being is that markets are they're very location specific. And, this is why you hear that the words, location when it comes to real estate, is that every market is going to be slightly different. They're going to have its own, it's going to have its own fundamentals, so it's not one market. But I do want to make an additional comment related to that, which is when we do the type of investing that we do, the value add strategy where we come in and make our improvements and force appreciation to the assets. This is what our investors pay us to do, is to drive value for these properties. Really, we need a market that is that gives us tailwinds, right? What does that mean? Well, we want markets that are growing. We want markets that have strong fundamentals. Those are you probably hear Adam talk about this all the time. You want job growth, you want population growth, because that turns into income growth. With income growth, you can give the market better product, and in return, they will give you higher rents, and therefore it increases the property value. So that's how it works, right? I've seen lately that there have been some operators that go to like some small town in the middle of nowhere in the Midwest. No offense to the Midwesterners out there, but because the cap rates are higher there, because it's relatively cheaper, but the truth is, not a lot of people are moving to those areas, and so it's going to be very difficult to execute a value add strategy in a market that may be losing population growth, right? So something really important to keep in mind. Okay. Again, real estate is very location specific, and specifically, even within the submarket, what we're looking for are deals that are underperforming, poorly managed, potentially under duress, especially if we have a property that's like 3 to 5 minutes away or a couple of miles away. We know that market so well. We know the markets street by street, and we know how to transform that property. I mean, this is where you buy value, and that is not going to be captured in the generalized data. Let me just finish on this topic by saying that, again, what's important is not only the markets that you pick, the markets that have strong fundamentals and growth prospects, but also an operator who's a specialist in that market. Because it's like when people talk about investing in different markets, you can't just compare Tennessee to Arizona to Texas to Florida. It's literally like you have to get down to the granular level and look at it street by street. Even operators that will use various research data from RealPage or CoStar, even that doesn't necessarily capture some of the data that you might be able to get from actually being boots on the ground, like when we do secret shopping, when we're actually inspecting the competition. Those are the type of things, like literally, like you need to be boots on the ground to be a great operator. So with that, let me take a little break, get some water, and turn it over back to my esteemed colleague Adam.
Thank you, Joe. That's excellent. And I could not agree with you more when people talk about real estate crashing. As I'm going to get into myth 4, but as I mentioned, we have 2 poll questions for you tonight. So we're going to, this was the results of the last one. So our second question is cactuses. Now, for those of you who are familiar with Arizona, saguaro cactuses, the giant cactuses with those huge arms, can be as high as 50 feet. How long do they live? Is our second question tonight. 25 years, 50 years, 100 years, or over 200? So again, answer, type in, click your answer. We'll reveal the answer at the end of when we get to Q&A. But also at this point, I'm going to remind you too, if any questions you have right now, be early. Type them in the Q&A box, and we will get to them at the when we wrap up our webinar. So anybody else out there, click in your answer. I'm going to need to close this in a few seconds. All right. Last chance. Okay. Could end it. So to follow up with Joe's last myth, he talked about real estate crashing. Another great myth out there is that commercial real estate is crashing. Now, what's important to remember too is when you hear commercial real estate, it's a blanket term. And when somebody says commercial real estate, a lot of classes fall under that umbrella. Mobile home parks, multifamily, office, retail, strip malls, shopping malls. So when you hear that term, commercial, if somebody says commercial real estate is crashing, immediately you need to look and say, okay, what are they talking about? Because there actually has been a couple, big stories that got nationwide attention in the last couple of weeks. There was one office tower in St. Louis, another one in Fort Worth, Texas, that sold for about a little over 90% less than what they traded for just in the early 2020s. But what's important to remember out these, what do they have in common? They were office space. Now, we all know what's happened to the office sector. Post-COVID, work from home has happened. And although you hear some talk out there of certain CEOs saying, you better get back to the office, it's not really happening. The last Wall Street firm I worked for, I checked in with my colleagues last. They said, yeah, we've decided, we do have an office in Midtown Manhattan, but we're all pretty much working from home. So this is really has continued despite a lot of calls out there for workers to return to the office. Now, to even break that down, one more step is, the retail sector. There's been a lot of talks out there about, certain malls that have had difficulty. And even those, you really have to, break it down case by case. I live in Scottsdale, Arizona, and in Greater Phoenix, not all malls are the same. There's a famous one that in Mesa that closed called Fiesta Mall. And why did it close? There was some very big box tenants there that didn't survive. You drive by the Fiesta Mall sign, you even still see an outline of the old Blockbuster sign, for example, there. And in Greater Phoenix, actually, I'll bring it on even tighter in Scottsdale. Close to the Costco I go to, one shopping mall there has fallen under hard times. Anchor tenants were a Sears, bankrupt, gone. Macy's, which a lot of the Macy's have been closed. Same with Bed Bath & Beyond. So this mall's not doing so well. However, Fashion Square, which is sort of the high-end shopping center that has all the high-end brands. It has Louis Vuitton, Gucci. There's a Tesla shop. Some of the really niche high-end fashion brands like All Saints is there. Tiffany and Espresso's got a shop there. So this one is doing quite well. So it's really important to really break it down in details when you hear these attention-grabbing headlines of certain real estate not doing well. And there's also even been some doom and gloom about strip malls. While some strip malls definitely have had difficulty being filled, other ones that have some good anchor tenants are doing quite well. Laundromats do extremely well, nail salons, gyms. So again, it's just really important to really break it down and just not accept any big blanket comments. So looking at multifamily, there's also been some attention-grabbing headlines about certain multifamily operators and some properties being repossessed by banks. A lot of operators issuing capital calls. For those who are not familiar with a capital call, what that is when an operator in the property is doing so poorly they can't make debt payments, that the operator reaches back out to the investors and says, hey, we're in trouble. I need you to give me a larger investment. You have to give me more capital. So you're hearing these stories out there, but it's important to remember that, one thing we always stress is with multifamily real estate is you're betting the jockey, not the horse. So it's really important to really vet them and look at the good operator and and look at their experience. Who's been through tough times, and an operator that's been through tough times and tough markets can really navigate and was not caught in like a lot of operators were when cap rates, or not cap rates, but interest rates really spiked. And overall, though, too, is there's often every market can often hit a difficult time. That's for sure. But while there's definitely a lot of these attention grabbing headlines out there, what's really important to remember about multifamily is overall the long term fundamentals could not be in better shape than they are right now. The when it comes to multifamily, there's three different classes. There's the A class. So you'll hear the term A class, B class, and C class. A class is really a new build that's aimed at young professionals. A lot of amenities, top of the line appliances. And the B and the C class is usually aimed at much more blue collar working class housing. Now, the estimate out there that we put in our presentation tonight is that there's a 4 million apartment shortage for blue collar housing. And I've seen numbers much higher. I've seen, a friend of mine on LinkedIn posted a story recently that the number is 6 million. And there's estimates out there as high as over 10 million. Whatever the number is, there is a shortage. And this is not something that could be remedied right away. This is going to take a long time to remedy. So the fundamentals for multifamily are exceptional. And another element too that's really starting to garner a lot of attention is single family residencies. The prices have gotten really out of hand. Compass just this week released a map nationwide and showed people how much prices have increased in their state just from 2020. Arizona was up 60%. That's how much a house has increased in value, or the price has increased since 2020 in Arizona. Nationwide, there's some areas that it's mid to high 60s. The lowest I saw is 22% in Louisiana. But whatever you are, people are getting priced out of single family homes. So there's a lot of people who are going to be forever renters. And again, this just really shows the fundamentals for multifamily continue to be exceptionally strong. So myth number 5, this is a really interesting one. Cap rates. A lot of people think that higher cap rates are more desirable than lower cap rates. That is not always the case. Now, when I was a multifamily realtor, when I had a property to show somebody and called them up, hey, got a property, I think it fits your parameters. 3 questions I was always asked. Okay, what was the price? Next question, how many units? Next question was the cap rate. I was always asked those questions. Now, what's really important, as we're saying here, is this can be, usually is, a very misused metrics when valuing a property. Now, a cap rate, just for those of you who don't know what it is, the bottom line, the net operating income of a property over the price. So if a property has $100,000 of net operating income, the selling price is $2 million, $100,000 divided by 2 million gets you to a 5% cap rate. Now, what a cap rate should be based on, the net operating income of the T12, which is the trailing 12 months. So the last 12 months is the proper cap rate, existing cap rate for a property. Now, when you see these flyers for these properties, it's not uncommon for the listing broker to use the trailing 3 months, and then multiply that by 4 and use that as the net operating income for the cap rates. In many cases, too, I've seen ones where they just put a pro forma out there, like, oh, it's a 6.5% cap rate. Well, you have to dig in the numbers and realize, okay, that's projections many years out. So the first part you really have to decipher is the cap rate they're talking about. What is it based off of? So that's the first thing when it comes to the cap rates. Just make sure it's a real one, not a made up one, as we're saying here. Now, also too, when it comes to cap rates, is there's not a blanket cap rate. You have to look at every cap rate for the subsector. So if somebody is just of self-storage and they're used to cap rates in 6% range, and then they see a multifamily property and the cap rate is just 5%, they may think it's not a good deal when that's not a apples to apples comparison. That's an apples to orange comparison. So you have to remember too, with just real estate overall, cap rates vary by the subsector. So that's something that really need to focus on when looking at them. Now, also, what's cap rates, not only do they differ within even within the specific sector, they can vary, quite a bit. So as I mentioned before, the differences, Class A, Class B, Class C, multifamily. Now, a brand new Class A property that it was just completed, has the latest appliances, a lot of amenities, and has no deferred maintenance. There's zero work that's going to be done for years. Now, the owner might be trying to sell this property at a 4 cap rate, and that may look, very low. Oh, that's expensive to somebody, and they may look then compare it to a C class property that was built in the 70s that needs a lot of work. Might need might need new appliances, new plumbing, a lot of issues, a new roof. It may need numerous work to be put into the property. Now that property could be trading or offered at like a 5.5% cap rate, and somebody may say, okay, well that's the better deal. When it's not the case, that C class property with a 5.5 cap rate, after you price in all the work that needs to be done for it, it might end up being a much worse investment. So again, it's not an end all number that people really, should pay the most attention to. Now, also another example too is identical properties. Now, there might be two multifamily properties literally across the street from each other. Same number of units, same build, same condition, and one might be rents market, and the property's being listed at a 6 cap rate, while the property across the street you might have rents well below market, and he's selling that property at a 5 cap rate. Now the 6 cap rate might seem more appealing initially, but that 5 cap rate property, you could possibly purchase that property when the leases come due, raise rents, and that end up net being a much higher cap rate. So again, it's not an end all number. It's a number to look at, but you really have to dissect it and not immediately assume that a property with a higher cap rate is a better deal. Now, what's also important to remember too is a lot of people, when it comes to multifamily properties, take a shotgun approach. They'll look at properties nationwide. And so they'll see a property, in Phoenix that's, listed at a, 5 cap rate and say, somebody show me something in Kentucky with an 8% cap rate. I might go with that. That deal sounds more attractive to me. They've been making a big mistake, because what's important to remember about the cap rate is it's pricing in the market. So it's really important to keep that in mind too. Joe before was talking about, tailwinds for certain, markets. And when you're looking at a place like Phoenix that, is having great population growth, great wage growth, economic growth, a 5% cap rate is probably a much better deal than a property in an area or a state that's not seeing any population growth. So again, that's not, this metrics is not all that's, it's made out to be. And just sort of to wrap this all up, a personal example I like to share with people was when I was a multifamily realtor, the last year of me doing that in 2023, I had 2 listings at one point, both in Tucson. One property was 20 units, one was 23 units. The 20 unit property we had listed at just over 6 cap. I think it was a 6.1 cap rate. Pro forma, we thought you could get this to about a 6.6, while the other property, the 23 unit property, had an existing cap rate of just under 8, 7.95. And pro forma, we thought you could get this possibly north of 9. And, somebody looking at these numbers could say, oh, wow, an 8%, cap rate in Tucson, I'm there. That's fantastic. But look at the properties, when I showed them to people, when I was asked, which property would you prefer? I always told my investors the 6%, the 6.1 cap rates. Why? Most of the renovations were done. This property was not a heavy lift. It was in good shape. The property was full. It was a great unit mix. The 20 units, there was 4 2 bedrooms. The rest were 1 bedrooms. While the 23 unit property was mostly studios. Studios have a higher turnover. And the property needed a ton of work. So overall, while on paper you may say, oh, wow, an 8% cap rate sounds so much more appealing, it wasn't. The 6.1 cap rate was a much better deal. So we're going to open it up to questions. As I mentioned in that Q&A box, please type your question. But one thing I do want to mention before we answer your questions, we're very excited. Break of Day Capital, we have just recently launched a preferred income fund. We're very excited about this. This fund offers investors an 8% preferred return, net of fees. You are going to see monthly distributions, so there's some solid cash flow. There's liquidity here too. If you do, after your money's been in the fund for 90 days, you can ask for redemption. Your money will be refunded in 45 days. And also, what we love about this for real estate investors is currently, if you have money sitting in a CD or a money market account, those returns, you have to pay ordinary taxes on them. And this 8% preferred return, you can offset the taxes with bonus appreciation that either you already have in a deal or you could potentially get in a future deal too. So there's some great tax benefits as well. So if you have any questions about this, again, we'll give our contact information at the end again, and you can reach out to us. So we're going to open up to questions. Again, put your question in the Q&A box. While we're waiting for additional questions, the answers to our poll questions for the evening. The first question, what fictional hit TV show was Gary Lipsky mentioned on? For those of you who guessed Suits, you are correct. The pilot episode 1 of Suits, it's on Netflix actually right now. There is a fictional character named Gary Lipsky who feels Lewis's wrath. He gets fired for not doing the work. Gary has some of Gary's friends, has many friends in the film industry, and one of them was a writer, director for Suits, and named a character after him. The second question about the saguaro cactuses, how long do they live? Over 200 years. They're really incredible. It takes a long time for them to mature. And what's great about them, what's interesting fact about them too, is they're protected. So if you do, I have several on my property. I love them. If I ever wanted to remove one or even or move it, I would have to do that with a professional team. So that's really interesting fact about those cactuses. They're native to both Arizona and Mexico. So again, do not be shy, please. Any question you have, we have one question that's been in the box that we'll read.
All right, Adam, I'll go ahead and read off these questions. Okay, so I think this one was pre-submitted. What would you consider signs of a market crash? And I'll go ahead and take this one since I lived through a couple of these.
Yes.
So things are always going to look the best before they get worse, right? It just, there's an inflection point, right? I think that some of the attributes that will give you the setup for an eventual crash would be extreme euphoria. When everybody is talking about, some particular asset class, be it, tech stocks or, crypto maybe. I think maybe crypto will be the one that is going to instigate a crash this time, we don't always know what causes it, but it almost always happens, right? And those are the things that we pay attention to. So looking for extreme euphoria, And as we human beings with our animal spirits, cycle between greed and fear, we are going to think that we're invincible and just use max leverage on everything. So, if I can make a 20% return and I can borrow at 5, I'm going to do that all day, as much as possible, right? So you're looking for excessive leverage. You're also looking for extremely high valuations. In the stock market, you might see, Nvidia PEs in the 50s and 60s. For us in the multifamily, real estate, it might be super low cap rates. Like maybe we go back down to threes again, and that's that T12 cap rate that Adam was talking about. Um, yeah, those are, I don't think I'm missing anything, but yeah, and yeah, basically, there's some $6 trillion of dry powder sitting on the sidelines today, sitting in money market, and that's going to be a great setup for another, you know, um, I personally think we're going to have another uh blow off top, another bubble before we pop again, and so there's still some time to make some real returns here. Uh, Anything I'm missing, Adam? Is there anything you want to add there? You've had a lot of experience on Wall Street as well.
Yeah, I've been through a couple, definitely bubbles. The dot-com bubble early in my career, and then obviously 2008. We just needed to give a number, don't have to describe it. But I think what you really touched upon was the euphoria of the is usually a sign to me that troubles are ahead because I mean I thought the dot-com bubble was much more interesting because as you mentioned, a lot of those stocks were trading at ridiculous multiples. And the old expression, is I think it was Joe Kennedy once said when the shoe shine boy was giving him stock picks, he kind of knew things were getting a little out of hand. And I remember during that time too, you talk to anybody, they loved certain dot-com stocks. Um, and every time I sat in a cab in New York, people were like, "Oh, what do you like? What do you like?" I mean, it was that euphoric, and I think that's really the thing to me that often usually indicates we're in trouble when there's great euphoria and things are trading at ridiculous prices. And as you mentioned too, when there's not a lot of dry powder on the sidelines too, when people are really leveraged up, because I know in 2000 people really leveraged a lot of personal trading accounts up to a ridiculous number.
Yep, perfect. Um, we have a couple more pre-submitted questions, but Saeed Hussein here asked a really good question. So I'm gonna go ahead and take that
Yep.
first,
That's
and
a
then
great
we'll go
question.
back. Yeah, we'll go back to the other ones. Yeah, this is great. Let me just repeat it for the audience. For commercial real estate investment, what is key metric to compare them? There is preferred rate, annual return, and IRR, or something else. This is an awesome question. So Adam, is it okay if I take this?
Yeah, absolutely. No, this
Okay.
is
Okay. So the thing to remember is, and then I hope that Adam and I impressed on you, is that before you even look at the deal itself, vet the operator. You know, how long has this team, how long have we been doing this? Are we any good at it? Prove it. Do we have skin in the game? Uh, what is our expertise in doing this, right? So I would say when you evaluate an investment, 80 to 90% of your evaluation should be done on just the team itself. Do they have the capacity to carry this process, to carry this business plan all the way through, to a successful exit, right? Once you're comfortable with the team and they've proven to you that, yeah, these guys are worth betting on, then you look at the deal. And the deal, honestly, where the market is not going to just give you something. Multifamily is of such an attractive asset class, both with everything from small mom and pop to like just kind of the below institution level like we are in, all the way to the big REITs, the Blackstones, whatever. Multifamily at this scale is extremely efficient. So unless you see value where others don't, um, the pricing is generally pretty market. Okay, so you have to be able to create value. This is my long-winded way of telling you that you're not going to be able to steal anything. Okay. And so therefore, when you see projected returns, there is a kind of a range that the market expects. And I'll give you some examples. If this is a stabilized, property, like a class A minus, very little value add, you're basically buying a market rate property. You're just going to collect cash flow. It's like a coupon clipper. You should probably expect to, receive, 10 to 12% IRR. Okay. The space that we specialize in, it's called value add. And basically what we're doing is buying some property where we can do something to it to increase the value, right? So with that, the risk is going to be a little bit higher because we have to be able to execute our business plan, making improvements, whatever it is, making renovations, uh, our most recent acquisition, the seller left a ton of meat on the bone, which we were able to correct in 2 weeks. And that's simply by reducing the water usage, by like 75-80%. And that increased the property value by $3 million. And it took us 2 weeks to execute, right? So with this kind of value add, you should expect to make about 15% IRR, okay? And then on the farthest end on the risk curve, there's ground up development where you're literally like getting permitted and you're like trying to build a new project. So no cash flow for 2-3 years, lots of risk. The city can come down on you. You might do something wrong. People might get hurt on the job site. The kind of loan that you put on these developments are not fixed. So, they got hurt even more during the recent rise in interest rates, going from, they're probably paying 10 to 12% interest rate for a construction loan, right? So it's a lot of risk. So with that kind of deal, you could probably expect to make, 20% IRR or more. Okay. So when you compare one deal to the other, you just got to make sure that you are within the expected range because, and I'm going to give you some ugly truth about a lot of operators, these numbers are made up. Okay. I'm just going to tell you that. Like, we have a spreadsheet. It's a black box. Well, we know what's inside, but you don't know, right? It's a black box. We put in a bunch of stuff. It spits out a number that, okay, we can take this to an investor. But all the inputs are assumptions. So we got to be pretty good at forecasting the future, right? So we can make up whatever number that appeases you, right? I've seen deals like ours with the 25% IRR, projected 25% IRR. What did you think, having invested in 60 deals at this point, what did you think I did when I saw the 25% IRR when we're used to 15? I didn't get excited. I threw that in the trash. You know why I did that? Because it was unrealistic. We've been doing this long enough to know what is real and what isn't. And you know what? And even if you could hit a 25% IRR for a value add deal, why would you even advertise that, right? A sophisticated investor will know that that's unrealistic. Like we've sold 3 deals where we average 61% IRR, but that's not what we lead with. That we don't tell people that. We tell people expect a 15% IRR because that is market expectations. That is what we aim for. Now, if we get lucky and we have a tailwind, that's even better, but outsized returns are possible. But to be conservative, you kind of want to just stick with what the market expects for a certain level of risk reward that you're targeting. Okay. So hopefully, by me being so long-winded, you understand that you can't just compare one deal to another, and one of them is 18% IRR, the other one's 15% IRR. So you think one deal is better than the other. It's not. And so again, this goes back to you have to bet on the team because a good team is not going to give you an aggressive IRR projection. I hope that answers the question.
So Joey, we have a second question, or sorry, another question that came. I shouldn't say second one. Or, does the new fund have depreciation?
Sure. Yeah, we get asked this a lot. So the preferred income fund invests in the preferred equity tranche of our portfolio assets. And with that, you have priority to the cash flows and the return of capital over common equity. And in doing so, you are trading off giving up upside, and you're also giving up depreciation in the fund, in the income, in the preferred income fund. However, there's always a however. The income, the distribution that you received, that you receive from the income fund, because it's generated from real estate, you can use depreciation from other assets, from whether you have rental properties, whether you invest in some of our other deals, whether you're in the impact fund or the one of our syndications, whatever depreciation that you have accumulated or that you're going to receive in one of our future deals, if you invest in one of our future deals, could be used to offset the income from the preferred income fund. Does that make sense? Okay, Adam, I see another question. What is going on in the AZ market right now? Do you want to take that one, Adam?
Sure, no, gladly answer that question. So the Arizona market, there definitely, when rates went higher, there definitely was a lull in the market for a little while. I mean, there was by no means a correction. It was just, prices kind of just were steady for a bit of time. But the Arizona market continues to be exceptionally strong. And we talked about the key indicators that we look for all continue to certainly be in place. We're still seeing incredible population growth, and not only seeing population growth, we are seeing continue to see good wage growth, economic growth, and what we love about I think what shows how strong Arizona is when the 2008 came around, why was Arizona hit so hard? Because the market was so reliant on the real estate sector. It was sort of a one sector town. That's not the case anymore. Arizona's become a very diversified economy. Phoenix and Tucson both have, a lot of tech companies now are not just here, they're building. Intel's always had a presence here, but Taiwan Semi is building this massive tens of billions of dollars they're investing into a plant here. There's always been a good aerospace and defense sector here. That continues. Financial services has grown tremendously here. American Express and Schwab are here, but almost every financial institution now has a presence in the Arizona market as well. And we expect this to continue. I mean, definitely the infrastructure we're seeing expand here too. The main highway in Phoenix, the 101, they're adding a lane to it. The highway between Phoenix and Tucson, the I-10, they're adding a lane there as well. So the state is seeing it continue to see strong economic growth. So that's why we remain very bullish on the Arizona market.
Yeah, Adam, if I could just piggyback off
Yeah.
your comments. One of the questions that I get asked a lot from investors is, what sort of stress testing have we done, in the markets that we operate in, as it relates to, what if we have another great financial crisis like in 2008, right? So first of all, that's a great question. But the truth is, Arizona, to your point, it is a fundamentally different market, than in 2008. I still remember those days. Las Vegas, many parts of Florida, Arizona, these three main areas were sort of the poster child, for rapid, real estate price increases. And then obviously not obviously, but the subsequent crash, things tend to revert to the mean. And so you have prices come crashing down. But what got us there weren't because of population growth, job growth, income growth, like the stuff that we talk about, why we operate in the markets that we do, those prices were driven by out-of-state speculators from California, from New York. I wasn't one of them. I just know about them. They were buying 30, 40 homes, on like a $50,000 salary, right? You remember those ninja loans where as long as you had a heartbeat, you could just keep buying, right? Oh, by the way, if you see that come back, then you know that, we're gonna get ready to crash. But yeah, it's just fundamentally different today. Even Vegas, I mean, besides the teams moving there, so many Californians move there for tax reasons. Like, you need all these businesses to support all this new population, and so they're just fundamentally different. And so it's very hard to say, oh, well, how is Arizona going to do, if we have another great financial crisis? I mean, nobody really knows, but I would tell you that it will do a lot better than it did in 2008 because it has the fundamentals.
So I just want to remind people too, please, as we said, do not be shy. And any question you have, please put in the Q&A box. We're here to answer your questions. And while we're waiting to see if anybody else answers or has a question, I just want to mention too is, Joe and I, this is what we do all day. We speak to investors, talk about real estate, our investment opportunities. So if you would like to talk more, as you can see, my information is up on the screen here. My email is adam@breakofdaycapital.com. And my telephone number there as well. You can call or text me at this number, the 602-529-2056 number. So feel free to reach out to me at any point as well. Connect with me on LinkedIn. But if you would like to talk some more, that's the best way to reach me. Either email or call or text me at that number.
By the way, Adam, in case we have any investors in the Midtown on First deal, congratulations. We were able to successfully exit this deal today. We closed today. We're particularly proud because it was a very difficult process. Selling a deal today in a in a bearish market, you know, it's hard, but we got it done. And I believe the net returns to investors still came in above projections, right? So I think it really goes to show Gary's expertise in asset management and his focus on operations.
100% too, because one of the things that we've talked about in some of our previous webinars is don't ever confuse genius for a bull market. Anybody is a genius in a bull market. That's easy. It's how do people do during difficult times, and this one really just shows how exceptional of an operator he is, that he can still get investors this return during a bear market.
I don't see any more questions, Adam.
Yeah, just yeah, I guess nobody else has any more questions. Again, don't be shy if anything comes up. But if your question was not answered tonight too, again, feel free to reach out to me if there's something you'd like to talk about. Not a webinar. Again, email adam@breakofdaycapital.com. Joe can be reached Joseph@breakofdaycapital.com. And my number's right there to call or text 602-529-2056.